Welcome back. You're with us on Trading Hour, and we have Devang Mehta of Spark Private Capital with us now to give us some sense on the market. Devang, good to have you on the show. So it's been a little volatile, topsy-turvy for the market of late. First of all, what is the sense that you have looking at the sort of mid-cap correction that has set in? Could this last a while longer given the party? Or do you think that mid-caps should be bought at every dip?
Thanks, Surabhi, for having me on the show. Yes, I think this time around, what we are seeing is last 6 months, particularly starting from, say, September, October to even February, the day yesterday, we have seen almost volatility creeping in every single month, where we have seen market correction by, say, a couple of percentage points or 3 or 4% for the overall market. This correction normally lasts for 2 days. Even mid-caps correct, and there is always a talk that goes out that the party seems to be over or it's done, right? It's a severe bull market correction that we all anticipate. But ideally, if you ask me, there are many reasons to not believe so. One, yes, clearly, I think the sentiment is very high or is very good rather for equity as an asset class in India. I think our market is a lot more, I can say, in a way, it's a fertile ground. If we talk about all things, right from the fundamental macros to even micros, to even companies announcing numbers, yes, it's been a mixed bag. So I will not say that the entire diaspora of the market should do well. It will probably narrow down as we go into the result season more, and probably in the next quarter as well. But ideally, yes, I don't feel that it's the party is over. There are a lot of good mid caps and small caps still available across sectors where you can probably do well. Some of these companies have, I have started to discount their valuations a couple of times ahead, which is right now very difficult to digest. And a healthy correction is always welcome. There has to be certain gravity to the proceedings because money making was becoming extremely easy. And that's why I see this correction as blessing in disguise.
Okay, Devang, morning. Thank you for joining in. In our last conversation, you said that on new age technology, you said you don't own it, but you are hunting, you're looking for opportunities. Well, from that conversation to now, Paytm has fallen more than 65%. Zomato has delivered a very strong set of numbers, superb execution. The stock is down well. Honasa has come off a tad bit from the highs. So from levels of about 500 plus, it's down to 450. Anything you've zeroed in on the new age tech companies? Have they made it to your portfolio or your buy list?
Honestly, Reema, yes, we have been watching this space since last couple of years, 3 years when these companies got listed, right from Paytm to Zomato. But we've been generally lucky to not buy even a single share for any of our clients. And why I say so, because in the initial part also when we were trying to understand this businesses, we had a very strong thought process which says that India values still company more on profits, and that is the way it has to be, right? The earnings per share has to grow, the profit pool has to grow, clearly the EBITDA pool or the profit pool, whichever you talk about. Most of these companies were still valued on sales, right? So price to sales is still a ratio which does not make a lot of people digest it very easily. So we generally have stayed far away from this space. Yes, we have been looking for opportunities across different industries. For example, there are a lot of sunrise sectors in renewables. There are this EMS companies, electronic manufacturing services type of companies. There have been companies in the energy space, a company like Hitachi Energy, which I am not suggesting, but this has been our portfolio and it's grown around 6, 7, 8 times in the last 4 years. There are these companies which are very in a niche space. There are companies like L&T Technology Services, LTTS, which is into I can say AI, robotics, or even a proper tech company. So our sights are on this type of companies which enable a lot of capex, which enable companies to sort of expand, improve their productivity and efficiency. That's where I always mean when I talk about sort of new age companies, rather than getting into companies which probably are not still profitable or have a lot of question marks on their sort of the right to profitability.
LTTS, is that a company that you own?
Yeah, LTTS is which company which we own since around, I can say, last 3-4 years, and it's done very well for most of our portfolios as well.
Got it.
Okay. Devang, finally, what is your take on PSU stocks? That's where the headlines have been, and the equally, sharp declines coming through. Where are you on the whole PSU debate, and what part of PSU are you still willing to put fresh money to work for?
I think yes, there is one space which clearly outlines or really outperforms the other PSU space in terms of numbers. So the PSU bank as a space still has some upside left, and why I say so, because most of the factors are right now hinting towards PSU banks doing very well. Yes, the valuations are caught up. Most of these banks were trading at 0.5, 0.8, one-time price to book, and these are now above one. Why I say that? Because yes, the borrowing figure that was that which we heard in the interim budget was also low. The yields fell down. I think most of these companies will make good profits on the treasury. Second, the lending environment also seemed to be improving. There is a bit of improvement in discretionary consumption, capex, which we talk about. Government borrowing figure also helps them to sort of not get crowded out the private space. So my sense is that PSU banks is one space which probably can do well for the next 1 or 2 years. You have to just hope and pray that a farm loan waiver or a bad monsoon does not come and sort of spoil the scenario. But other PSUs also, as I said, a lot of PSUs in the power space, in the defense space are doing well, but most of these companies are factoring in the next couple of years profits, which is a bit scary. And this is why this 15-20% correction or 25% correction is most of these businesses will again make them a bit attractive. But you have to just be very clear and pick and choose rather than getting everywhere and anywhere. That's, I think, the order of the day.
Thank you, Devang, for joining in. That's the view coming in on the markets. We will slip into a very short break. On the